I have a business, right? But what happens really is when the frustration of life appears and how do all those pieces work together? When you get that tax bill that's due, does the money leave the business? Or hey, when an opportunity shows up, are the investments, do they have to be sold? And then
Yeah,
if you do
are
sell those
you
investments, do you
illiquid,
get a tax bill?
right? Are you illiquid?
Yeah. Are you, well, yeah, what's your liquidity look like, right? So is
Yeah.
there a both and strategy that's out there? And that's kind of what we're going to get into. Because on paper, most folks are doing everything right. And what you'll find is that a lot of folks are asset rich and cash poor.
Yeah, so having the same net worth doesn't mean you have the same lifestyle, right?
Welcome to another episode of WealthWise Banking. I'm Jeremy Lee Huggins here with my co-hosts, Jason Patrick Sipple. How's it going, man?
It's going fantastic, man. I got good news today. I got good news. How about yourself? How are you?
Well, let's hear the good news. What do you got?
See, I like the teaser. I wasn't gonna tell it for a little bit. Doc said I am completely healed. I'm allowed to do everything. My bones all healed. I can go and run. I can go and cycle all I want. And I told him that's good because I already went cycling because I already figured I was healed. But it
Yeah.
was a good conversation, man. It lifted my spirits quite a bit, and I didn't realize it was something I was worried about. So
For those of you who don't know, an old man Sipple here had a hip replacement.
call
So
me one hip sip. Pretty soon I'm gonna be two hip sip. Don't forget that. If you
yeah.
walk up to me when you meet me and you call me two hip sip, I will laugh out loud, hopefully. So
Well, good. I'm glad you're up and running. You got the spirits coming in, and Diego's coming back pretty soon, so the house is going to be full again. So
there's people looking
everything's
out the window excited. I got foods getting made right now. People getting ready for our tournament this weekend. Connor's performing three times with three different teams. Our instructor's becoming a master. There's all kinds of stuff happening, man. All kinds of stuff happening.
lots
So
of stuff. Lots of stuff. Well, uh, if we're looking at stuff that's happening in the financial world, terrible
yeah, wow,
segue.
that was a good that.
So one of our listeners sent a video to us, right? And it's got a couple million views at this point. And the person who kind of sent it over, like I know his background, right? He makes a lot of good money. He's a good saver. He's a moderately good investor. He's owns a couple assets. But really, at the end of the day, a lot of his money doesn't work together, right? We've heard that before, haven't we, Jason?
We've heard that quite a bit.
Yeah, so he's got like a bunch of cash that sits in the bank, a little bit of money that's out in the market, some retirement savings kind of set aside, a little bit of real estate. And by and large, if you looked at his assets, right, most people would say for all intents and purposes that what he's doing looks absolutely responsible. And then his tax bill lands, right? Or let's say, heaven forbid, he has to have a hip replacement. Something happens in his life. Is the moving of the money between the accounts, how's that affecting his whole financial life? And that's why he's actually shared this video. Is like, hey, it's starting to click, right? Because the video that we saw is one where they use the Federal Reserve data to explain how wealthy households actually handle cash. And honestly, in the video, Jason, they actually got a lot of this right. The question, though, isn't really where should I be putting my money? Today, we want to unpack this question. How do I build a system where every dollar works together? And if you stay with us toward the end of the episode, we're going to talk about a financial tool that both of us like to use that kind of the viral video left out, right? Part of the whole analysis, they kind of left this one asset class out. And it's one that really affluent families tend to use generationally time and again. So let's go ahead and get into it, Jason. How's it sound?
It's well, one, like what he did right? Like you said, like he talked, and I found it really interesting. I had this in my notes, and we kind of hit this for a second, but like uh one group, of individuals, they save about 13% in cash, right? And or no, it was 13,000 was what their cash reserve was. And then you had people that making over $1 million, they saved 6%, but that ended up being like a hundred and some thousand dollars, like $130,000. And then you had the top 1%. Well, they only saved 2%. That's over $700,000 in cash,
Yeah.
right? So like the percentages kind of lied to you, number one, and they have a lot of reserves. But his whole point with this was what money has to stay in motion. This is what, is done. And we're going to go through and unpack this. And like you said, for some reason, people just seem to leave out this one asset that's been around longer than everything else. It,
Well, the traditional folks leave out the one asset, right?
yeah.
The wealthy don't. It's actually an integral part. We've kind of discussed about it in a previous episode with Ernst and Young, right? A
Yes.
massive financial juggernaut and what they found in their findings and studies. What we're looking at here is that a bad financial system doesn't always look obviously bad, right? You could
Correct.
have legitimately good pieces in place today. Like I have a high yield savings, I have a brokerage account, I have a retirement account, I have a business, right? But what happens really is when the frustration of life appears and how do all those pieces work together? When you get that tax bill that's due, does the money leave the business? Or hey, when an opportunity shows up, are the investments, do they have to be sold? And then
Yeah.
if you do
Are
start with
you
investments, do you
illiquid?
get a tax bill?
Right? Are you illiquid?
Yeah. Are you, well, yeah, what's your liquidity look like, right? So is
Yeah.
there a both and strategy that's out there? And that's kind of what we're going to get into because on paper, most folks are doing everything right. And what you'll find is that a lot of folks are asset rich and cash poor,
Yeah. So having the same net worth doesn't mean you have the same lifestyle, right? Depending
or
on
even the same
where.
access to your net worth.
Yes. Well, that's what I meant by the same lifestyle. Like if you don't have cash flow, you have opportunities. We always talk about urgencies and emergencies. Like how does your whole system, as you led off at the beginning, how does your whole system work together, and what stress do you actually feel when it doesn't?
Yeah, absolutely. The investments that we're looking at here, it's not really, I don't look at it as, hey, what investment earns the most amount of money? I think that's the wrong question. I think it's really what investments are supposed to fill what roles, what jobs, right? And then how do they, like to your point, work together? Because I want my assets to be an ecosystem. They should have access and liquidity, but I also want growth. And to not be confused, when we get into one of our favorite asset classes for this foundation, it's not an investment at all. And we don't espouse it to be an investment. We've had comments about, hey, this is a terrible investment. Guess what? I agree with you.
I agree as well.
So,
Nobody's arguing with them, right? We're always like, I always get confused by that. Like, why are you telling me that? Like, I already understand this. Why? I know it's not an investment. I know you could do better over here or over there, or some of this viral video cover places where you're gonna get a better return on your money. That's not the point. That's
yeah,
not
and
the
I want
point.
to give the video a lot of credit because they got a lot of good things right in it. When we looked at the Federal Reserve data, they really compared like two hypothetical people, right? And I kind of want to like give a summary of what those folks were doing, right? So they had two hypothetical people, but they gave them five different places that the money could go to. So when we're looking at those, the percentages you kind of already, allocated them out, like the top wealthiest in the families, like they have that 2% set aside, but the gross net, the $700,000, that was a liquidity that they had at any given time. Where poorer families actually had a higher percent of their net worth in savings, but it was an overall lower dollar
Yeah, it
amount.
was
Again,
15% and $13,000. That was the whole
15%
key.
and 13,000.
Yep.
Yeah. So I think it's worth discussing kind of the challenges behind keeping cash available and liquid and why you want that. And for anyone who says, I don't have access to cash, I don't have access to liquidity, let's start with those money patterns. Again, that's a previous episode, but we've addressed that before, right? There is a way to automate this and actually, literally automate your net worth.
And with, I mean, with what we're talking about right now, like one of the things that you might hear some of our peers talk about, and I see a lot in social media, Jeremy, people say things like banks are the enemy. Like,
Oh, yeah.
right? Like banks are our enemy. That it's bad to have your money in the banks. It's like, wait a minute. If the whole concept is more control and doing what the wealthiest have been doing forever, then it's really what the banks are doing is when we leave money in the bank, they're going out and they're putting that money to work, right? They're
Yeah,
moving the money. Money stays in motion. It is a law.
you still need the bank at the end of the day. I mean, you need bills that have got to get paid and money's got to get transferred. Businesses have to operate, right? There's still going to be short-term obligations where we need cash, and that's a quick place for it to go. Now, does all your money, all your liquidity sit in a bank? No. And if you look at these wealthy families, when they're talking about overall percentages, we're not saying that all of your liquidity should be sitting in a checking account, stagnant, where you gave up a little bit of control and there's fractional reserve banking and yada, 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 right?
Well, yeah,
I don't
where
want to go down that
you're
rabbit
making
hole.
0.001% on your money that's sitting there. And that was a big that actually that was a really cool part of this viral video is he actually showed what like these two different people, right? One person It's kind of like the parable of talents. One person just let it sit there, didn't do anything with it. While the other people that had the other guy had his money in the bank as well, but then he chose to put it in things that made him more money that stayed ahead of inflation.
Yeah, and the idea, like to your point, I'm glad you brought it up because there are folks in our space who will say that banks are the enemy. But when we're looking at it, banks just simply earn money by taking deposits and then they lend those dollars elsewhere and they're earning a spread. Honestly, there's nothing sinister about that. I do the same thing when I lend money through my Roth IRA and I put it, I lend it out to developers. I'm making a spread. There's nothing sinister there, but a savings account shouldn't be expected for long-term growth. It shouldn't be there to protect your family. It's not going to create multi-generational continuity at all, right? There is an asset that does do a lot of those, that does have a lot of those same jobs. The mistake really is leaving that money somewhere by default and then expecting that location becomes the overall strategy. That's not the case.
No, and again, if you heard us, so what we're really talking about, and I talked about this earlier today, is we're saying that the banks aren't the enemy. Well, what is the enemy then? In my mind, Jeremy, the enemy is the system that we've inherited, the system that is right there in front of us. Like the banks are there. You can look it up online and see what the banks are making with the money that's left there. You can see what they're paying us. Like it's all fairly transparent. So that's not the enemy. The enemy is the thinking. The enemy is the mindset. The enemy is the system that is not understood except by the wealthy. So when you're looking for success, you're looking for clues. So we're really just kind of pointing out some of those clues of what they
Yeah,
look
yeah.
like.
I had a conversation. I'm very, very blessed and fortunate. I had a conversation today with a gentleman. He has 11 children. All right.
I was wondering
His
how that went. I'm glad we're getting
yeah,
into it.
family is $70 million net worth. Okay. And here's something that he hit on, and I keep finding the same pattern is that every wealthy family ensures that that dollar has a job. Like, what is the meaning behind the money?
Yeah.
By and large, a lot of us who don't have money, we grew up or we didn't have money growing up, we think that more is better. More of what? More like, do you actually need more money to solve your problems, or do you need to figure out the direction for money? Does it have a specific job? If you're looking at giving your dollars direction, that's what you really should do is if every dollar has an assignment, it has a job location, then you're able to actually determine where these investments should go, what should be accessible, what should go into these different accounts, right? How much taxes are going to be owed on these things. When we're giving dollars direction, giving them actual assignments, that's what I found time and again is that these wealthy people, these wealthy families, they actually assign jobs to their dollars, Jason. It's insane, right? They look at them as members of their team, not expendable pieces of paper.
Yeah, and that's what a powerful reframe. I mean, I'll be playing with it. Like I'm learning how to think like that. It is a habit that you form over time. Because I used to look at, oh, I had a great month. I've been really wanting that cold plunge. So I did this in 2023. I went and spent 6 grand on a cold plunge. I bought a liability. The wealthy are not buying liabilities. By giving their dollar a job, by having an assignment with the job or the dollar, it's going out and making them more money. Like you said, it's their team. And
Mhm.
then they get the thing that they wanted. Like that's
Yeah.
the difference between being broke and being rich is if you're buying liabilities or you're buying assets, right?
Yeah, so let's play a game with our members here, right? If you're listening, if someone gave you $500,000 tomorrow, right? And
Mm,
let's say it came through maybe an inheritance, or if you're a business owner, you know how you had a pretty nice exit or you sold your property, okay? Something along those lines that got you a $500,000.
yes.
A lot of folks will immediately start asking, where should I invest this money? I think that's the wrong first question, and here's why, right? You got the X sign going up. Go ahead, Jason.
Yeah.
Why is that
No,
the
just
wrong first question?
because I mean the first thing you're doing is you're looking, well, the first thing I thought when you asked the question is, oh, we want to put our money to work, but we're immediately looking for a bucket that doesn't have a lid. We're looking for an investment, a return on the money to put it to work, and we're going to put that money to risk immediately.
Hmm.
That's the first thing I thought is we're going to take what we have, what we just got. We're thinking smart. It might seem responsible. It might seem like the disciplined thing to do. I understand my money has to make me money. And so the first thing you're looking for is well, hey, let me go invest it in something and put it at risk. That's what I heard.
Yeah, the better first question, honestly, is what should this money accomplish? If you think about it, right? Because
Yeah.
you might have taxes that are now owed, or hey, I need actual money that's there for liquidity, or hey, this allocation here, this is for long-term growth, or this is for a future opportunity. We talked earlier about urgencies, emergencies, and opportunities, right?
Yes.
What if you already have debts? Should be a portion of it being paying off debts, right? What if it should never be exposed to market timing? The real question isn't like, where can I get the highest rate of return? The real question is, what is this money meant to accomplish? Give it a role, give it a job, give it an assignment. It could be to protect the family. It could be long-term growth or to create income. It could be there for opportunities.
I got my hand up now. Call on
Yeah.
me. Call on me. My turn.
In the back of the room, go.
So, Jeremy, like my thought here would be immediately like, yes, ask a better question. I'm even going to give you a little bit different question. I'm going to take us in a not off direction, but I would say, like, if you're 3 years from today and you're looking back and you feel really proud of what you've accomplished financially, what needs to be true? Like, you start setting up your destination of where you're going, even more than what's this money need to be doing? Like, where do you want to be in 3 years? Like, what has to be true for you to feel like you've made progress? Because that progress gives us happiness. Or even take it out further, go out 10 years. But most of us can't even imagine past a month. But so, like, go out 3 years because it's still something that's not going to be fairy tale land, right?
Yeah, and if that feels hard or overwhelming, guess what? It might be when you start because you're reprogramming your thinking. That's what you're
Yes.
doing.
Yes.
And it feels heavy at first, but then it's going to become second nature. Like the more you practice this, the more you do it. When you get a dollar and you literally like just look at a dollar and just, all right, I got 100 pennies here. How many of this is allocated to here and here and here, right? I know that it's sometimes hard. Maybe the first step is just literally creating liquidity. That's it. A dollar earned is a dollar saved, right? Just start there.
Yes. Just start with the first law of wealth, which we covered in other episodes, right? Just start paying yourself first. Start being first in line for your money.
What I don't want folks to do, and kind of like this member here that we started off with, the one who sent us the video, um, the focus should not be the rate of return, the annual return. I think that gets lost in the scorecard, right? So if we do, like I said, I mentioned, if we do imagine like just $2, okay,
Yep.
$1 can earn a very high projected return. But what does that do to that dollar? It's immediately likely going to be exposed to some sort of market timing, whether that's in real estate or crypto or equities, stocks, bonds, right? It's going to be exposed to some sort of market timing. Accessing it. What does it cost to actually access that money? If you do put it into a qualified account like an IRA or 401k, are you triggering taxes to access that money? Maybe some of it shouldn't be available unless you actually sell something. Like I know Connor talked to me about Pokemon cards, right? That's kind of
He's
an
still mad about that.
asset.
He's still
So,
mad
so
about
we're
that.
looking at that dollar, right? What is the highest return? Or you could take a dollar and then you could also look at the flip side of that coin. Just flip it over. Hey, is this meant to be stable? Is this dollar meant to be accessible? Is it meant to be
Yeah.
contractually guaranteed to have access? Is it positioned in a place that I can respond to urgencies and emergencies? Which one of those dollars produce a better return? And guess what? Based on that question, you cannot answer that until you assign the role to the dollar. Until you give that dollar an actual role, you can't answer that question on which one would produce a better return. Because a dollar can return growth and liquidity, but a dollar can also give you opportunity, protection, right? Peace of mind. And when you give that dollar direction and assign a role to it, now we can actually start answering that question. Hey, what produces the better return? Well, it depends. What's the role?
It sounds like you just gave the dollar a cape, man. It sounds like you just gave the dollar more than one job. It sounds like this dollar just became a super dollar.
Well, it should be looked at as a member of your team. It really should be. Like you have a bunch of little Avengers out there. Every dollar
There you
has a different
go.
role. You know, that maybe that's why we have faces on our dollars, right? The Benjamin has a specific role and the Franklin and everyone else, right? Or Ben's
I
Franklin,
think I
the
think
same
you're I
person.
think I think you're onto something. I think that's why, right? So now we're putting a cape on the dollar. It has more than one job. And you said something pretty interesting because this is something when I first and just again vulnerably, right? Because building the foundation, giving the dollar, having super dollars now, we recaptured all this money back to our family. We built up this liquidity fund. We put the money out to work. The money came back and we're like, wow, we've replaced a whole income with the money, the cash flow that's coming back in, and it triggered a bigger tax bill.
Mm.
right? I mean, it's a great thing to have. It's a good problem to have, but all of a sudden I'm like, oh, well, we didn't strategically think further than, hey, we want the money to go make us money.
Yeah. And kind of, I mean, if we're looking at wealthy families and what they're doing, there is a financial tool that we alluded to earlier that very affluent families they've been using for generations. And why is it that these sophisticated families keep using this asset long term, right? What is that? Let's go ahead and define it. What is that tool, Jason? What is it?
Ooh, it is um Pokemon cards.
Not this one, not this go
Oh,
round.
oh, let me try again. Can I try again?
Yeah.
Okay, this is like the Family Feud thing, right? So I think my second guess is going to be it's a participating whole life from a mutually owned dividend paying company.
Yeah. And so what ends up happening when people hear that, right? It's typically one of two extremes.
Oh, everyone just shut off they just changed the channel, man. They just stopped listening to us. They walked out of the room. They fell asleep. They died. They said, Daddy Dave says, don't do that.
Yeah. Well, to be very clear, whole life insurance is not a stock market replacement. It's not a replacement for your investments. It's not real estate. It's not in your business. Yeah, hell, it's not even a high return investment, right? Because it's not an
It's a
investment.
terrible investment.
Yeah.
Terrible.
Yeah. So we both are very much in agreement on that. But what does it do? What does it provide, Jason?
Well, it provides all kinds of things, man. I mean, you're giving me these softball questions. It provides not only does it provide liquidity, not only does it provide protection from attorneys, not only does it provide guaranteed growth that's tax free or tax advantage, not only does it provide, what else does it provide, Jeremy? It provides
Cash
uh,
value growth.
cash. Yeah, I mean, guaranteed growth. It not only can it provide, it's not guaranteed, but it can provide you dividends. Not only does it provide access where your money never gets interrupted. I think that's one of our favorite things. That's what we're talking about with assets. And
One
on top of all that, you get a cherry on top. It's going to provide a guaranteed estate, which is why the wealthiest families use it to make sure there's a multiplication when we graduate. They
yeah.
actually make their death, that graduation moment, become a beneficial thing for every generation to come after.
Yeah, and one of my favorite things, everything that you just said there, non-market correlated, meaning it's not tied to daily market performance at all. At all. It's its own asset class that sits outside of stocks and real estate and bonds and crypto, right? Affluent families are really using this to maximize the same metric time and again. It's a both and asset. They want capital that is designed for growth, but sometimes it needs to be designed for opportunity, sometimes for protection, sometimes for guarantees against market losses, right? If I want access and liquidity when the market drops, where do I go? Well, hell, I don't want to go to my portfolio and sell more shares at a loss.
Yeah.
What could I do? Or what if I have that opportunity that comes up? If I'm a business owner and I can't make payroll by the end of the week, what do I do? Tell my staff, hey, thanks, keep working. No, you don't do that. You have an emergency fund, a peace of mind fund that just happens to also give your family protection, guarantees, growth. That's what this does. It provides get contractual growth and guarantees. Again, not a replacement of your investments. The dollar just simply has a different job. That's it.
No, and if you're using it like the bank, then this is what provides you with control and protection with your investments,
Mhm.
right? Like, and what I mean by that is if, say, you have a lot of liquidity because you've been building this up over time and hundreds of thousands of dollars within your own system you control, and you put it to work to make a bigger return. Now you're making money two different places. And say, like, something happens to the investment where all of a sudden the money, it becomes a non-performing asset. Well, guess what? You still have a performing asset on the other side that's still growing and kind of protecting you from that.
You want to hear my cheat code? I'll be
Yeah.
honest. So I have six policies. Jason, I don't fund any of my premiums. Not a single dollar do I fund. Not a single freaking one. So how is it that I'm building all this cash value and this tax-free protection for my family, building generational wealth tax-free? Well, in the beginning, I was funding it, but then I built up enough cash value to start buying cash producing assets. Those assets started spitting off revenue. That revenue funds my annual premiums. So for
That
me, it's
sounds like
real
a
estate.
circle. That sounds like a circle or a wheel of wealth, my friend.
Yeah, I use real estate. My tenants pay my premiums. I know other folks that don't like real estate. Hey, that's fine. What do? Dividends, stock dividends. They allow dividends to fund their premiums.
Which were
Literally
all,
one
these are
asset
all
funding
things,
another.
by the way, that were talked about in the viral video
Yeah.
as places that, because in the end, we understand like the simple math behind it is your dollar is the most valuable it'll ever be today because every day in the future it's getting eaten up by inflation. So you have to be able to go out and make the money go to work for you. That's the only way to actually put your dollars to work. So Jeremy's built his system. Go back to your system, Jeremy. So now you started funding it. Eventually you build up that reserve I was just talking about, the opportunity fund. You started buying assets because you knew, like, and understood real estate. And you were very involved with that real estate this past weekend, right? Making sure things were going the right way. And you ended up making more assets with this.
Yeah. And my tenants, those assets produce income. That income, a portion, not all of it, a portion of it goes to fund the annual premiums, which does what? Rebuilds the cash value that I use to purchase new cash flowing assets. My asset class that I like, real estate, is just simply more tax benefits. I get to keep more of what I earn
Yeah.
because I want to do it all on a tax-free basis. If you want to do oil and gas or you want to be a business owner, there's a lot of different ways. I just choose real estate as my favorite asset class, suit your fancy, right? Whatever works for you. At the end of the day, figure out a way that you have one asset funding another. That's what I would recommend.
That's it. And that is a beautiful, like you have all the spokes going, you have the protection going, you have all of these things. So let's bring this back to the builder versus borrower distinction,
Yeah,
right? Like
yeah.
how's the builder like you just told us how you approach it as a builder, but how does a builder approach this differently than a borrower would?
Well, a borrower is going to go back to asking that one question is where can I get the highest rate of return? What they're really asking is like, what's the location of money at the end of the day? That's what the borrower is asking. But a builder is going to start assigning that role up front. They're going to start coordinating the movement of capital. When you start assigning roles for dollars, that's when you give that dollar a job and you can allocate a portion of your net worth, your cash flow accordingly. So when we're looking at borrowers, borrowers are really looking at a collection of products. They're going and doing exactly what the financial industry wants you to do, which is buy everything in pieces. Sometimes it starts with a checking account. Then guess what? You build up enough money, you get a mortgage. And then, hey, guess what? You're going to get a retirement account and then a
Hmm.
brokerage account. Maybe it is a little bit of insurance. But then guess what? When life happens, how does the borrower respond? Well, typically they'll go to whatever account is easily accessible.
Yes.
Again, those dollars didn't have jobs. They're literally grasping at straws and now they're panicky. They might be in like one problem may actually become five problems when you start looking at selling assets, taking on taxes, what else it's going to cost, a loss opportunity cost, right? So, what does a builder do, Jason? We just talked about the borrower. What does a builder do in order to create order?
Well, first back to the borrower. Like the borrower, Jeremy, is living in an environment of reaction,
Mhm.
right? The one thing I always ask you, what's the one guarantee in life?
Change.
Change. Well, change
After
happens.
84
Change.
episodes, I got it.
Yeah, after 84 episodes, change is always happening. It's always happening for the better, or the worse. It's always happening. And so when you're reacting, like you said, you set off a chain of events. Like every action is going to have an equal and opposite reaction. Sometimes it's going to be awful that in the terms of you think, oh, I'm solving a problem in the immediate because I'm reacting, and all of a sudden you cause five more problems
Mhm.
versus the builder is being more intentional, being more proactive. They're thinking long term. They're thinking about building a system like your system just really impressed me. Anybody else listening thought that was impressive? How you heard Jeremy thinking through, like it's the thinking that's impressive. So when we start looking at instead of looking at the best investment, what we're really talking about is let's go ahead and look at how the builders and the wealthy, the 1%, build the best systems.
Mhm. Yeah, builders are going to start allocating jobs to their capital, right? What money needs to handle a normal expense? What money needs to be there for emergencies and urgencies? What's there to protect my family? If I did have a liquidity event, what should not be disturbed? Like what money do I always leave there just in case, right? What you're not doing, and this is what I found in talking with all these families. So I've
Hmm.
done over the last year, I've helped over 100 business owners and financially savvy families basically put this system in place. And what I find time and again is that they're not searching for the perfect investment, Jason, at all. What they're doing is they're actually engineering cooperation between different financial tools.
Yeah.
That's exactly what they're doing.
And Jeremy doesn't like to brag about himself, but they actually created an award for Jeremy, and that's why he was out wrestling leprechauns. And I did the solo episode. I mean, he told me that he beat down some leprechauns, he stole some pots of gold, and he brought it back to the States. Don't tell anybody, right? I mean, that happened because he was out there winning awards because he's helped so many people. And that's a Zig Ziglar thing, right? Help more people get what they want, and you're going to get more you want. Jeremy, you're crushing it, brother. Like you literally built something where they built an award for you because of the people you've helped, the
Yeah.
builders that you've helped. So
Yeah. We're just getting started. So that's what's
just
great.
getting that was another great takeaway. Jeremy finally gave himself some credit because he talked to some old people there that have been doing this for 50 plus years. He's like, wait a minute, we're just babies at this. We've been doing this 5 and 6 years collectively. We got a decade between us doing this, bro. So
Yeah. No, I appreciate it. It was a really good time, great experience, learning a ton from other folks who've been doing this for decades longer than I have. So it was fun. We got to get you out there this next year. So,
it sounds like a good plan to me. So with, and now we go back to like we're looking at again what I was talking about, like not looking at the best investment. We're talking about the best system, a collection of the tools.
mhm.
So like if someone remembers one sentence from this episode, Jeremy, what should it be?
I think that maybe I'll give you like two sentences here. Okay. Most people are trying to find the best investment. All right. If you're trying to build true wealth, like wealth that matters, something worth protecting, wealthy families are really trying to build the best financial system. That's what you should be looking at. It's not the best investment, not the greatest, highest return on anything. It's a system, it's a collection of goods. It's how does it all fit together? Because a great investment inside of a bad system, honestly, Jason, it can still produce frustrating, absolutely frustrating financial results, right? Because the market could be doing absolutely well, but you have no liquidity. All of my real estate investor friends out there, asset rich, cash poor. All the money's tied up in the walls. Well, what about your business? Your business could be growing, but is that leaving your family exposed? I talk about real estate. Real estate could appreciate, but again, do you have to sell it to access it? Or, hey, do I have to go get a loan against it, a home equity line of credit in order to access it? That's not accessing your money. That's getting a bank to borrow you money. Okay. That's what's happening. So every single one of these pieces, honestly, they sound good, but they're not systems, right? Wealth is not what your money earns. Okay. Wealth is how all of your money works together. You have to assign jobs. If you take nothing away from this episode, I want you to start thinking about what dollar has direction? Where does my money go? What am I assigning it? What role does it have? And if you start looking at it like that, like assigning roles, everything else starts falling in pieces. Like the puzzles start falling into place. That's what's really happening. Wealth has to be engineered, and no one's going to
Yes.
engineer it but you.
Yeah, and you have to engineer something that has a strong foundation, and that foundation actually becomes a roof later on, right? Like that's the cherry on top. Like you have the strong foundation to do everything we just talked about to build the system. You have all of these benefits that you can use the money without interrupting it. And at the end, that's how you create the legacy piece, right? So if this rang true to you and you felt like, you know what? I want to do more like a builder. I want to build the systems. I want to have this conversation and know what these strategies are and put it together and see how it fits in my life. Go to wealthwisebanking.com and schedule that strategy call. Have that strategic meeting to see how this is going to work for you.
Yeah. What I want you to do is start looking at your investment accounts, right? Well, we can look at what you already own and then start seeing how it fits together. Like, what's the glue between all of this? We'll look at how you're currently positioned, what gets disturbed if life gets a little bit messy, what roles do you already assign your dollars? And if they don't
Mm.
have any roles, let's start assigning them today. So, like Jason said, go to wealthwisebanking.com, schedule a review. The best investments in your life, they're going to change, all right? Markets are going to shift. Those investments are going to go up and down, but a well-designed system is going to benefit your family for generations. Absolutely. So with that, I kind of want to leave it with that, Jason. For a lot of our members, you're already in banking, but
You're just not the banker yet.
all right, we'll see you guys next week. Take care.
Be blessed. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, Stay inspired, stay in control, and keep building your legacy the wise way.